So it's pretty interesting. So many of you have asked me about whether Singapore banks are still worth buying today. Over the last year, we see all the three local banks, DBS, UOB, OCBC, have actually hit close to its all-time peak. DBS was up about 50% over the past year. UOB is up 30%, and OCBC is up about 34%. A lot of this growth, number one, for the last couple of years, in fact, if you see, for the three local banks, they have performed really, really well. And a large part of it is number one, because of the high interest rates. Singapore banks have been able to take advantage of high interest rates to increase the yield or the lending yield on their loans, which means that they're able to actually make a much higher profit margin. Another thing as well is also the growth in the assets. The three Singapore banks primarily have their loans in mortgages in the property cycle. And if you see for the Singapore market, property has been one of the big run-up over the last couple of years, especially since the start of the pandemic. This has been a big driver for all the three local banks, and as a result, share price performance have done really well. That also have resulted in the Straits Times Index soaring about 20% over the last year. So if you see the Straits Times Index, which comprises 30 largest Singapore stocks, half of the value is actually coming from Singapore banks. So DBS, OCBC, and UOB have been a big driver of performance. Now, what's interesting is that then with its current share price performance, with its share sitting at all-time peak, is it still worth buying all the three banks today? What's interesting is wealth management is actually driving most of the bank's profitability and also its share price performance. If you see DBS in its latest quarterly results last year, wealth management is actually one of the contributing factors for its growth in fee income. This is actually compared to its other fee income businesses, which we are actually looking at it right now. And if you look at wealth management, the growth of the wealth management for DBS is actually much higher than its other business segments, specifically in fee income. Now, let's take a look at OCBC as well. OCBC is also the same thing. If you see its latest third quarter 2024 results, fee income was up about 10% year on year, 9% on quarter, largely driven by, again, wealth management. If you see the largest growth contributors is actually coming from this segment itself, which surprisingly is driving OCBC's share price performance. Same goes for UOB as well. Wealth segment is also one of the big drivers. So if you look at the three local banks, it is really driven by a growth in its assets under management, or rather its wealth management business. DBS have actually almost doubled its AUM since 2017. OCBC and UOB has also seen sort of a meaningful climb in their assets under management in their wealth management business. And really this is because Singapore has positioned itself as a wealth hub to strategize itself as one where it attracts money from all over the world, especially at a time when China is still struggling with its property debt crisis. There are still capital controls, and generally people are just afraid of the economy. The consumer confidence is down as well. So that has sort of affected wealth going to Hong Kong. A lot of the capital is actually flowing into Singapore. That's why we are actually seeing Singapore banks seeing huge surge in their fee income. And you can see all the three local banks, they are actually seeing much faster fee gains than their lending income. So lending income is basically the income which they make from lending out their money to companies, to consumers, and for mortgages as well. Which brings me to the next point. Is it worth buying today? Singapore banks, or banks in general, I typically use the price to book ratio as valuations for banks. And if you notice for DBS, historically, the average price to book ratio which it trades is roughly about 1.3 times. So 1.3 times means that DBS tends to trade at about 30% premium from its book value. Book value basically means taking the total assets of DBS, you minus off all your liabilities, which mostly takes up your deposits. What is left is actually the net worth or the shareholders' equity, which is also the book value of the bank. Because DBS has quite a consistent growth over the last couple of years from growing its loans and also its wealth income, it typically trades at a slight premium, at about a 30% premium to its book value. Now, What's interesting is that in recent years, the price to book has actually gone up much higher than its average. In fact, DBS price to book ratio today trades at almost close, in fact, the same level as it was back during the global financial crisis. We all know the global financial crisis, we see all the three local banks trading at very high multiples. DBS was trading at about 2 times price to book ratio, which is the same level as it is trading today, which means that if I want to actually buy Singapore banks, whether it's DBS, OCBC, or UOB, I want to be buying when it's at least trading below its average price to book ratio. That means I want to be buying it at a discount from its average valuations. Now, there are periods where the banks actually trade at pretty high valuations. Somewhere in 2018, there's one, 2022 to about 2023, there's also another one. There are also times where DBS actually trades at a deep discount to its average price to book ratio. So that was at the bottom of the global financial crisis, 2011, where we saw the US debt crisis unfold. And then we also have the 2016 Trump election and the interest rate hikes. And then, of course, during COVID as well. So these are some of the key areas or the opportunities where we actually want to buy Singapore banks. And this is a very useful chart because it tells me where are the exact entry points where I can actually buy banks like DBS. Now let's take a look at OCBC and UOB. OCBC and UOB over the last 10 years, if you take a look at the last 10 years price to book, historical price to book charts, you can see how OCBC UOB has also started to climb as well. So it has actually traded way beyond its average price to book ratio. Both OCBC and UOB have an average price to book ratio of about 1.1 times, which is lower than DBS, probably because the growth in DBS is actually much stronger. And that's why investors are actually placing a much higher premium for DBS book value as compared to OCBC's and UOB's book value. However, if you see UOB currently is trading about 1.31, close to 1.4 times, which is higher than its average 1.1 times price to book. OCBC is also the same thing, which is also trading very close to its all-time high of 1.5 times price to book valuation, even though its average price to book is only about 1.1 times. So if you look at it from a price to book approach, it does seem that the Singapore banks, while they're doing really well in growing their wealth management business, growing their fee income business, the big problem is that it seems like the market is putting a big premium on the share price today. As you can see, DBS is trading very close to its global financial crisis valuations. OCBC and UOB are trading at close to its all-time high over the last 10 years. So this tells me that, hey, I probably want to be a bit more careful when I want to invest in Singapore banks. Sure, there might be a good dividend yield today. All the three Singapore banks, they have seen really good return on equity or ROE as a result of higher interest rates, higher profit margins, higher fee income from wealth management business. But the price which we are paying is actually at a much, much larger premium today as it was compared over the last couple of years. Now, if you see, then the question comes, when do we actually start to buy Singapore banks? It's pretty interesting because Singapore banks are actually very cyclical in nature. Its share price performance actually moves in cycles. Look at the last 15 to 20 years. Singapore banks have actually at one point traded in cycles. First time in the global financial crisis, then in the US debt crisis in 2011, Trump elections plus interest rate hikes, and of course the COVID-19 pandemic. So there are actually opportunities to accumulate or buy Singapore bank shares because they move in different cycles. And what you want is to avoid buying some of these high quality assets at very elevated prices. Instead, you want to pick off these high quality assets at really the right price or at a big bargain to its intrinsic value. And you can actually use the price to book value or the price to book ratio as one measure to take advantage of the opportunities. As a dividend investor, what I really like to look at is this thing called a dividend yield cycle. It's also the same thing. When you're talking about dividend stocks, they tend to trade like a pendulum between extreme high dividend yield and low dividend yield, extreme high price to book valuation, low price to book valuation. So if you look at the dividend yield over the last 10 years for these three local banks, today the banks are trading anywhere between 4.7% to 5%. So about 4 plus 5%. DBS traditionally has been trading about over 7%. The most expensive time it has probably traded was in 2021, 2018, 2015. The time where you probably want to buy the banks, also the time where it was trading at a very high dividend yield. So that was back in 2020. That was during the COVID-19 pandemic. Also back in 2023, late 2023 to early 2024 was also a good time. So if you ask me, hey, Willie, is this a great time to be buying Singapore bank shares today? My answer is not at the moment. I do own all the three local banks in my own portfolios. I don't think I'll add on more at this current level. But what is interesting is if, let's say, if you're going to start building a position in Singapore bank shares or Singapore banks, then my take is that I would actually wait for the price to book value to start reverting back closer to its mean before relooking at some of these banks. However, if you point a gun at my head and you say, hey, really, is this a great time to actually be buying? What sort of banks should I be paying attention to? Then maybe I'll probably be looking at OCBC as the most attractive because it's trading at about 5.1% dividend yield. DBS would probably be one of the most expensive today, trading about 4+%. Just so because its mean dividend yield is about 4.17%, and the highest dividend yield is about 7+%. So that's actually quite a big gap from its highest dividend yield level versus its most recent dividend yield today. This is my assessment of Singapore banks. And if you like it, do feel free to follow, like, and subscribe, and I'll see you soon.